just take a time, build a bit of a brand, a bit of a focus, and and have fun with it too, because it is pretty fun.
If you're considering investing in startups, you've come to the right place. The wingman of startup CEOs, Nathan Beckord, is more than an expert. He's one of the foremost leaders in the startup world. In this interview, he shares insights on how the startup ecosystem works, what to look for, and how to invest. Nathan has made a huge impact on many startups as the founder of Foundersuite.com, one of the first platforms to help startup founders connect with investors. He's also widely recognized as the host of the popular How I Built It podcast and a regular host of various startup networking events around the country. Nathan acquired his experience honestly. He started in investment banking before unleashing his inner entrepreneur. His most recent venture is fundingstack.com, a platform to help the broader investment world raise capital. Nathan has a lot of wisdom to give and a lot of passion behind it. Welcome to my conversation with Nathan Beckord.
Pickleball, really addicted to pickleball, like half the country is at the moment. Sailing, motorcycles, family. Maybe not in that exact order. Put family up top just to make me look like a good dad. But yeah, it's awesome.
So you're a sailor, motorcycler, and now an avid pickleballer, and and a founder and doing all kinds of incredible stuff here, really in the entrepreneurial space. But among founders and among those in the startup world, you've really become a powerhouse. And I want to hear the story because I love the story, but I want to hear it again. And if you can tell it to me from like maybe an investor's perspective of what does that look like from the development of Foundersuite?
Yeah, I mean, I'll tell you the story of how we got here, right? How we got to Foundersuite and then Fundingstack, which is our newest platform. But
yes,
so I'll tell you the story of kind of how we got here. I mean, the short version of a somewhat long story is, I went to school out here in California, grew up in Colorado, came out to Santa Clara University because I wanted to be in Silicon Valley and see what was going on out here. Graduated and wanted to be an investment banker because that was in the late 90s when things were really kind of popping in technology. And so started working in investment banking, helping companies go public, and then went to Texas for a business school and did some investment banking after that. Worked at JP Morgan in their New York office doing later stage fundraising for, Series B, Series C companies, private placements, things like that. And it was really exciting, right? It's like, I'm a capitalist. I love kind of how capital flows to, worthy companies, right? Both in public and private markets, right? It's a pretty efficient market. I mean, it's not perfect. And so it was fun being part of that. But I didn't really love investment banking. I mean, it's grueling hours, especially when you're at the lower levels, I just remember like being at home on a Sunday morning, like chilling and getting the call. You got to come into the office. We got a deal that needs to be done by Monday, and like, okay, that's going to be an all-nighter. It was just like your life is, you're on a leash kind of the whole time. So anyway, didn't love investment banking and always wanted to be an entrepreneur. But what I learned how to do is raise capital. And so came back out to California and started working with early stage startups, seed, Series A companies, and we package them up, something you learn doing investment banking, how to build a pitch deck, how to build financial models, things like that. So we'd package up these companies and then build investor lists for them, right? Here are some VCs to go after. And then sometimes we'd actually go out and attend the meetings down on Sand Hill Road with these companies and coach them, along the process. And then at one point, I'm like, you know what? I really want to be an entrepreneur. Why don't I build some software for doing this process, right? Like, because people are using spreadsheets and things like that to like track an investor pipeline. I'm like, why isn't this software? There's 100 different CRMs out there for managing a sales pipeline, and fundraising is really just another sales process. Why not build a fundraising dedicated CRM? So long story short, that's what led to launching Foundersuite. And this is 2016. So we're been in the market for a while, and we launched with an investor CRM and came out and added a bunch more products to it, investor database, pitch deck hosting, data room. We've just been kind of expanding the tool set. And then just to connect the dots to kind of the present, we've had 87,000 startups use it, 17 billion raised by those startups, but we started to get some VCs and some advisors, funding advisors, using Foundersuite, and we're not really building this for you. They're like, I've been using this with one of my portfolio companies. I like it, but I've got a couple other portfolio companies. How do I work with those guys? And so a little light bulb went off, like, oh, let's build a version for VCs, investment bankers. And that's what led to Fundingstack, which is only a few months in the market. So pretty new product. But that's kind of the 20-year journey.
It's awesome. It's an awesome journey. And you've created something that's really helped the industry in a totally unique way, and really spurred momentum, I think, in a way that otherwise would not have existed. So, but why, when you left investment banking, why did you decide to go into startups in the first place? You dealt with all kinds of businesses. Why startups?
I love startups. I think startups are kind of glamorous, kind of sexy. There's that creation. Creation of anything is exciting, but the creation of a new company with the potential lottery ticket element to it is even makes it more exciting, right? Startups are just fun. They're exciting. They're dynamic. I could go on about why startups are a terrible business. They go out of business. Most fail for a variety of reasons, internal, external, right? Startups are very hard to build a business around. They're cheap. They're poor. But startups are just exciting. It's fun, right? It's like, if you want a thrill ride as a career, startups are it, right? You want something a little more stable, secure, point you to a lot of other directions, right? So
Yeah, no better chance to get a grand slam, right? It's hard to get a lot of singles, any single, but getting the grand slam is always the most exciting opportunity with them.
totally, right? You know how these economics work. Most venture returns are driven only by a handful of, a small number of portfolio companies. That's kind of how the model works. But when you find a rising star, catch a rising star, right? It's pretty exciting. We've had a few. We haven't. I wasn't like early on Facebook or Google, but we've been involved in a few that pretty early that have gone on do some good things. So that's always fun. It's exciting.
So when you're thinking about startups, you obviously hit a pain point. You knew that there was a pain point with fundraising and getting that initial capital, which is a huge pain point for any startup anyway. When you're looking at that, though, as you're assessing that need, what was it about that relationship between investors and startup founders that you felt you could solve?
Yeah, it's a great question. So as I mentioned a minute ago, raising capital is basically a sales process. It's very learnable by anyone, I believe. But most founders, 99.9% of founders have never raised capital before, right?
Mm-hmm.
It's new to them. So it's very learnable. It's very trainable. Uh, but, but it's not like innate to being a founder. You're probably, if you're a startup founder, you're probably either a product developer, an engineer, a coder, or maybe you come from the business side and maybe you're a salesperson or, marketing person. Um, Not many people come into the startup world having raised capital, right? They're not coming out of investment banking. Not many investment bankers go on to start startups,
Mm-hmm.
but those are the ones that do know how to raise capital. Anyway, so you know the pain point is really founders do it wrong all the time, and so you've launched a startup, you put your life savings into it, you realize it's time to go raise some money for this. A lot of founders screw it up because they don't know what they're doing. They haven't done it before. They haven't really been trained. And so, I guess the opportunity is to provide these tools that kind of provide the guardrails or guide rails, whatever you call it, um, to keep them on the right track, doing it the right way. There are a lot of small nuances to raising capital that can trip people up. We talk about fundraising being a numbers game. You've got to talk to a lot of investors. At the same time, you can't spam investors. Each one has to be kind of a direct one-to-one relationship building exercise. So it's like there are a few nuances and contradictory things that trip people up. And so we're really trying to just make it a little more efficient, more process driven, using tools to implement best practices in fundraising. That's kind of the opportunity right there. help founders do a better job. Now, not every startup is fundable, of course. A lot
Mhm.
of startups still won't be able to raise money because they're just not really a fundable business. But if you are a fundable business, we like to think we can make that process of raising capital way easier and more efficient for you.
And I'm imagining that it probably eliminates a lot of the risk from the investor standpoint too, because you're guiding the startup founders on how to engage in that process.
Yeah, I think so. I like to think that if you have kind of gone through and done some of our best practices, you're going to be a better prepared to go talk to investors. You're not going to waste their time. You're going to be a little more vetted, right? Because hopefully you've got your pitch deck polished up, you've got your numbers, your metrics, you've got like when I do a funding hacks talk, and there's a lot to it, but one of the things is preparing a data room, uh, getting all your diligence documents ready. I mean, there's a lot of things you can do to really make the process easier,
Mm-hmm.
not only for the start founder, but for the investor as well.
Yeah. So, and can you walk me through the process? What is it like from the beginning, from that investor relation standpoint? What does that process look like going from we're ready to bring investors in to investors are signed and we're moving forward?
So, again, continuing with this theme of fundraising as a sales process, which I talk a lot about, step one in the sales process is building a target list of investors, right? There are hundreds of thousands of investors out there. We have 150,000 in our database, angels, VCs, corporates, family offices. But step one is identifying the 200 or so that are like a good fit for your business, right? The right industry, right stage, right geographic location, ideally ones that have a new fund or fresh capital to put to work. I mean, there's a lot of criteria of what makes a good
Mm-hmm.
fit. But anyway, step one is always building that target list. Step two is figuring out how to get in contact with them. And of course, the warm intro is always the best way. And there are multiple ways to get a warm intro. Most founders don't come into the world having a huge Rolodex of investors. I mean, maybe if you went to Harvard Business School or something, you did come out of there with a large Rolodex, but most founders don't, right? So
Mm-hmm.
they're figuring out how to get the contact going, and then of course getting momentum going for your deal, right? Um, One of the things I always tell founders is like investors can smell whether your deal has momentum or doesn't, or whether your deal's gotten stale, right? And does, the opposite of
Mm-hmm.
momentum. And so we talk about some different ways to get momentum going for a deal, getting investors kind of in a frenzy over your deal. And then, of course, closing the deal, getting through due diligence, preparing that data room I mentioned, getting through that, and then closing the deal on terms that are good for you. That's kind of in a high level view the end to end process.
You just mentioned the deal getting stale. What does that look like? And investors can sense that pretty quickly. But what does that look like tangibly if you were to put it into words?
It is one of these things you sort of know it when you see it. It's hard to describe, but you know it when you see it. But some criteria like the founder's been raising capital for quite a long time. Maybe it's 4 or 5, 6 months, and not really getting close to a term sheet with anyone, right? It could also mean the founder is just going slowly. One of the things I tell founders, you have to pretty much push everything off your table and just go in and fundraise almost full time for a couple months, right? So, but founders are busy. They've also got product,
Mm-hmm.
team, marketing. They have a lot of stuff going on. And sometimes I see founders come in and kind of part time the fundraise. And so it just drags on. And there's never a catalyst for the investors because investors will just watch and wait if there's no catalyst to get them to take action, right? And so that's another factor. Either the fundraising has been going on too long, or the founder's not really putting in a lot of time. And definition of stale is lack of interest plus too much time. Um, you know, and investors can smell like, oh, these guys have been raising like, um, you know, John contacted me back in 4 months ago, 5 months ago, and we did a quick little intro call. Now it's 5 months later, and he's circling back up, and he still doesn't have a lead or any term sheet. Like this thing is clearly has no momentum behind it, right? That's
Mhm.
another big definition of staleness. So
Once you get past that and you realize that, okay, there is going to be a deal to be made, investor wants to get in. What does that last piece of the process look like between negotiations? What kinds of documents need to be signed? How does that all kind of fit in?
yeah, I mean, you know, first is obviously to get a term sheet, or even better, multiple term sheets. I mean, if we think about it, right, you're talking to investors, you're pitching, you're probably coming back a few times, pitching progressively more people if it's at a venture fund, right? Eventually, it will be the entire partnership in the room that you're pitching. Maybe you started off with just one person and kind of got up there, and then it becomes term sheet negotiation of um, all the terms in a deal, and that there's a lot of stuff there that we could get into, but
Mm-hmm.
um, you're trying to optimize kind of for both valuation, terms, and probably most importantly, fit with the investor, right? Who really can help your business, because not all investors are created equal, and and then you're choosing um, one good lead investor, someone who's going to take the majority of the equity and put in the most money on the deal. And then it's always nice to fill out that round if you're going to have more than one investor with maybe two or three other investors that could add value. Or like in our case, in our seed round, we had one uh, seed venture fund lead the deal, and then we had a bunch of angel operators. People who one of our angel investors was a early. I don't know if she was CFO or controller at Facebook, but people who have kind of been in the trenches, right? So trying to put together that ideal cap table that of firms and people who can help you grow it. And then it's signing the docs and wiring the money. Basically, that's kind of the boring
Mm-hmm.
part. The more fun part is like hustling and finding the right people, putting together this dream team of investors around your startup.
But you just alluded to something really important, that dream team, because angel investors, I think one of the neatest things about startups is there's a real relationship between the founders themselves and the investors who get involved. And there's almost this dynamic that can exist if the founders are open to it, which I find that they are most of the time, to having their investors come in and sort of have a hand in continuing that building process. What's your experience been like? Have you ever heard any good stories about that? What are your thoughts?
Yeah, I mean, like, I'll use ours as an example. I love our angel investors. They're not super active. They're not out there hustling for Foundersuite or Fundingstack every day. But if I need to call them up, I'm stuck on a thorny issue, I can do so. It's great. It's great to have this sort
Mm-hmm.
of board of advisors. And frankly, you can kind of put your angel investors to work as much or as little as you want. And of course, as they're willing to do. I know some startups that are really active. They really lean on their investors to open up, doors, find hiring candidates, things like that. Others are more passive. I'd say I'm a bit in the more of a passive category where I need some help. We send out our newsletter, our investor update. We have a product for that in our product. But I send out our investor update, and I usually have a little like how you can help section if I need some advice on a pricing model, business model. When we launched Funding Stack, I put that out there. Hey, we're looking for intros to potential emerging manager VCs, things like that might be good beta customers. But I mean, angel investors are busy too. They're humans. They're
Yeah.
probably have 5, 10, maybe more deals that they've invested in. So they're obviously not going to be like a full time contributor. But I love having a good team, and um, yeah, it's wonderful.
So on the other side, what should investors expect from the founders themselves throughout the process after investment?
You know, I am constantly pounding the table, beating the drum about sending out a regular investor update. Right? It's one of the easiest things you can do as a founder. Uh, well, let me answer your question more directly, and then I'll get back to my rant about investor updates. You know, you're an angel investor. You just put money into a startup. Maybe it's 25K, maybe it's 50K. Um, you want to know what's going on. You want to know what's happening with that business. And a huge complaint of angel investors is, like,
Yes.
I've heard this phrase where I don't hear from them until they're like out of money, right? Or something like that. That's a
Mhm.
common complaint of angel investors. I never hear from them. I have no visibility into what's going on until they're
Yes.
like almost out of money or, you know, or being sued or something like that, right? Um, and so they want to be kept in the loop. They most do like to be helpful and active, whether it's just giving advice or, opening doors, making connections. But to do that, you've got to keep them in the loop, and that's why I love the investor update as a tool to do that. Right? I tell founders block off, you know, half an hour on your calendar, the third Friday of every month. Right? Just have it as a regular
Hmm.
kind of standing meeting for yourself, and then go in and create a little investor update that just talking about like what happened last month, the good, the bad, the ugly, where you need help, your metrics, so they kind of get a snapshot of how you're doing in terms of like your cash balance, your runway, your revenue, your cost of customer acquisition, like other key metrics, and then just spend 20 minutes writing this, send it out once a month, so investors are kept in the loop. And then, you know, obviously, you can take that even more extreme. I know startups that will have a monthly dinner or quarterly dinner where they bring all their investors together, and that's all good too, right? But I think at a
Hmm.
minimum, to answer your question in a long, long way, at a minimum, just keep them updated with a monthly update.
I love that. And I love the idea of having the dinner or something like that too. Just to your point, for an investor, it makes a lot of sense to come in and get to network with other people who are like minded enough to invest in a similar startup. So I don't. I think that's tremendous advice that you're offering to any startup founder. Now, as I'm thinking ahead, I'm just wondering if you have any advice for investors, for people who are looking to get into startups, who want to be an angel, who want to join an angel, something like that. What advice would you offer folks in that position right now?
Yeah, it's an interesting question. You see angel investors like here, I'm here in Silicon Valley. I'm in San Francisco, and these companies go public, which creates a lot of wealthy people all of a sudden, and a lot of
Mm-hmm.
times, you know, uh, they will start investing in startups and things like that. One little bit of advice I would say is once you decide to become an angel investor, maybe you just had a windfall or whatever. Start a little slower than you would expect because I've seen angels go in and they're just like writing 50K checks at a fast and furious pace, and then they need to like take a moment to digest all those deals, right? So just
Mm-hmm.
almost like kind of develop the discipline to be able to um, look at deals a little more gradual and just be patient with it, right? Like don't rush into doing a lot of deals. Um, and I think also, I see angel investors that will have or kind of develop a little bit of a thesis, kind of like a venture fund. Like
Mm-hmm.
I'm an angel investor. I'm investing in longevity focused startups. I've got a buddy down, a pickleball friend, who's kind of investing in like mental wellness and longevity startups. But it's great because he creates a bit of a brand around that, and therefore when I see a startup on Foundersuite that's in that space, I'm like, oh, hey, do you want to take a look at this deal? Like it's also becomes a magnet for deals of that type by kind of having a brand around that, right? And then of
Mm-hmm.
course, if you can double on that and be a really useful, helpful guy in that space, that's going to get even more deals. And so, just take a
Mm-hmm.
time, build a bit of a brand, a bit of a focus, and have fun with it too, because it is pretty fun.
That's awesome. I love that. Create your own like micro VC. Become by having a thesis and developing I guess a brand. You said there's something else you said,
Develop a brand and be useful, right? If you've
and be useful.
not
That's it.
only are you branded as
Yeah.
the guy who writes 50K checks into longevity startups, but you're also really helpful in recruiting in that space or whatever the helpful part is. Maybe it could be financial, but you're also a really good guy that is good at reviewing financials and helping, tune up the
Mm-hmm.
budgets and things like that, right? Doesn't matter what that helpfulness is, but that's good. That's a double whammy. So
Well, awesome. Well, Nathan, that's a great spot to end. Thank you so much for being here, joining me today, and imparting this tremendous wisdom for us. And wish you all the best with not just Foundersuite, but of course Fundingstack now. Very exciting ventures. Thank you so much, and have a great day.
thank you for having me. Appreciate it.